What's going on, y'all? It's your boy, Crypto Rock. All Cryp, love to none. Hey, listen, thank you for stopping by the channel. Having a sound understanding of monetary policy is key to identifying good opportunities in the market. Low inflation is a long-term goal of the Fed. The Fed regulates and supervises banks. Regulation in the form of written rules, supervision in the form of enforcement of rules. Now, when was the last time the Fed checked Silicone Valley Bank? What was Silicone Valley Bank's rating? Now, I ask all of this for a reason. Let's talk about it. We back, so you know I'm not gonna waste your time. Now, according to the FDIC, as of December 31st, 2022, Silicone Valley Bank had approximately $209 billion in total assets and about $175.4 billion in deposits. According to CNN, as of the end of the year, Silicone Valley Bank said it had $151 billion in uninsured deposits, of which $137.6 was held by American customers. On Thursday, March 9th, customers yanked $42 billion from Silicone Valley Bank, leaving the bank with $1 billion in negative cash balance. Amazing. The question is, why did the Silicone Valley Bank collapse? Short on cash, SVB was forced to sell its bonds at big losses, prompting concerns about its financial health. Within 48 hours, spooked depositors had withdrawn enough funds to cause the bank's collapse. Silicone Valley Bank collapsed because of a stupid rookie mistake with their interest rate risk management. They invested short-term deposits into long-term bonds. When interest rates rose, the value of the bonds fell, wiping out the equity of the bank. James Angel, an expert on regulation of global financial markets at Georgetown University, told Al Jazeera. This is the same phenomenon that wiped out the U.S. savings and loan industry in the 1980s. Some people never learn. Hey, I didn't say it. I just read it. Now let's get to the meat, the Fed. Now, let me just say this. I'm only giving you guys surface information, just enough so you can understand, so I can get to the point. Remember to always do your own research. Always do your own research. Why was the Fed formed? A severe panic in 1907 resulted in bank runs that wreaked havoc on a fragile banking system. And so ultimately Congress in 1913 wrote the Federal Reserve Act. And so the Fed was created to address these banking panics. Of course, it's not responsible for several broader responsibilities, including fostering a sound banking system and a healthy economy. Now, the Fed influences the economy in 4 ways, y'all. Number 1, manipulating interest rates. Number 2, open market operations. Number 3, reserve requirements. And number 4, influencing market perceptions. Let's go over the 4 of them. Number 1, manipulating interest rates. This is what's happening now. It's about raising and lowering interest rates to slow or speed up the economy and to control inflation. Number 2, open market operations. This is when the Fed is buying or selling treasury bonds. This is very similar to manipulating or controlling interest rates. This means when the Fed buys bonds, it increases the money supply in exchange for cash. On the opposite, when the Fed sells bonds, it decreases the money supply. When the Fed sells bonds, it pushes the price down and rates increase. Now, from a bank perspective, because they use some of your money, some of our money, to buy bonds, when the Fed raises interest rates and bond prices fall, a bank may sell their bonds because of the loss of value. Number 3, reserve requirements. The Fed sets reserve requirements to 0. This happened in 2020. Banks are required to have 0% in reserve in the US. That means they can lend out all your money. Nothing else needs to be said. And then number 4, influence market perception. You've been hearing this all year of last year. For example, the Fed may say the economy is growing too quickly and it's worried about inflation. This would mean an interest rate hike is coming to cool the economy. Now, assuming the market believes this, the bondholders will sell their bonds before rates increase and so that they don't experience losses. Now, as investors sell bonds, prices go down, interest rates rise. This in effect would accomplish the Fed's goal of raising interest rates to cool the economy, but without actually having to do anything. Now, according to several news reports, the CEO and shareholders of Silicone Valley Bank sold a large amount of their shares before the bank run. Now, as a result of market perception, do you think Silicone Valley Bank CEO and their top executives knew something we didn't? I'm not gonna say anything. Did the Fed cause all of this? Was this intentional or not? Or is this part of the greater actions that lead to opportunities? I mean, how do you see it? Comment below. Now let's talk about the banks. Banks use your money to make money. Banks use our money to make money. Banks use our money to purchase bonds. If rates are increasing, when the Fed sells in the open market, the interest rate collected on a bond purchased by the bank goes down. A bank will be forced to sell their bond so the investment doesn't turn sour. But because they probably used all of their customer deposits, since the reserve requirement is 0, then they probably end up in the red anyway. I mean, it's just a situation. I'm just saying. I don't even know if that's true, right? I already talked about it. U.S. banks are required to have 0% in reserve, which means they can use all of your money. I've seen talk on the socials, I've read it, that this was a coordinated attempt by the U.S. to shut down the Silicone Valley Bank. I'm not making those type of accusations. I mean, others say it was an attack on crypto because, I mean, this was the 16th largest bank in the U.S., and it was a bank that supported crypto adoption. My response, when one door closes, another door opens, right? This was a bank, y'all. Another centralized corporation. Now, I'm not taking anything away from what they did or what they were aspiring to do for crypto, but at the end of the day, it fell because of centralized operations. It failed because of centralized operations. Now, I don't think I'm against banks. We need it. They have to function. I'm just making a point for decentralization and more control of what belongs to us. Freedom to control what belongs to us, rightfully so. Now, sound, secure regulation to foster adoption is necessary. I believe in that because you can't stop crypto anymore. Now, let's bring it all together. The bottom line. What does this mean? I said it at the beginning of the video. Having a sound understanding of the monetary policy is key to identifying good opportunities in the market. You can look at it in two ways, y'all, because perception is everything. You can be in your feelings and you're like, oh my God, the US hates crypto and they're gonna make it hard for us and I'm not gonna be able to purchase my crypto. Or you can recognize an opportunity to get out your feelings and get in where you fit in. Just looking at it from a different perspective, y'all. You focus on what you can control. It is what it is. 3 types of people in this world. Those who watch things happen, those who make things happen, and those who say what happened. Hey, listen, follow us on our social media channels. Remember to like, comment, subscribe. It's your boy, Crypto Rock. Catch y'all on the next one.